Imagine waking up in Johannesburg and discovering the rand has dropped overnight. Suddenly, your morning coffee and fuel cost more, all due to trades made far away in London or New York. Currency manipulation is a complex, often hidden element in global finance. It ranges from central bank measures aimed at stabilizing economies to illegal tactics that manipulate rates for profit. But how do these financial giants exert such influence over emerging markets like South Africa without being physically present? In this first part, we'll dive into the why behind these connections and explore motives that drive central and commercial banks towards specific currency behaviors. Are they acting out of economic necessity, a quest for profits, or other factors? Come along as we reveal the inside story behind the forces impacting the global south. Central banks like the Reserve Bank and Federal Reserve play a significant role in their national currencies. They aim for macroeconomic goals like managing inflation, supporting economic growth, and balancing employment. These banks' actions are part of legitimate monetary policy rather than malicious manipulation. They might use tools such as setting interest rates. For instance, the South African Reserve Bank effectively raised rates to combat inflation. Quantitative easing allows central banks to inject money into the economy by purchasing government bonds with newly created money. This approach can increase the money supply, sometimes weakening the currency to encourage exports. A great example is how Japan's extensive QE programs aim to bolster its export-driven growth. Furthermore, central banks might directly buy or sell their currency in foreign exchange markets to stabilize or adjust their value. These methods are generally legal, transparent, and focused on achieving economic stability. The forex market is immense, valued at $7.5 trillion. Large commercial banks actively participate, and their trades can sway currency prices. However, their intentions aren't always about nefarious manipulation. Commercial banks trade for various reasons. Profit. These banks capitalize on currency fluctuations, serving clients like corporations needing to hedge international deals. Large transactions they conduct can influence markets, particularly with less liquid currencies. For example, a bank making a huge order to change dollars into euros can momentarily strengthen the euro. Speculation. Some banks trade based on predictions involving economic indicators, geopolitical events, or market trends. Such activities can heighten volatility, especially in emerging market currencies. Client services. Banks facilitate currency exchanges for multinational businesses, governments, or hedge funds, often involving trading large amounts and impacting exchange rates. Certain countries leverage their central banks or state-owned institutions to impact currencies for trade benefits or to counter challenges. Weakening a currency to lower export costs can spark a currency war. For instance, Donald Trump claimed that China keeps the yuan undervalued for export advantages, while China defends this as part of broader economic management. Nations facing sanctions or economic restrictions might manipulate the currency to stabilize the markets or fend off external threats. A significant example is how Russia's central bank intervened after the 2022 sanctions to support the ruble. Currency values rely heavily on supply and demand within the global forex market, where banks are key players. Major trades from either central or commercial banks can influence exchange rates, even without deliberate attempts to manipulate. The boundary between legitimate market practices and manipulation becomes unclear when banks take advantage of insider information or collude, mirroring past scandals. High-frequency trading or algorithmic methods can amplify volatility, leading some to argue that this distorts fair market pricing. Impact on trade. Currency fluctuations affect the competitiveness of global trade. A weaker currency can boost exports but inflate import costs, impacting consumers and inflation. Global imbalances. Continuous intervention by one country can create trade imbalances, causing tensions like those between the US and China. Ethical concerns. Bank collusion or exploitation erodes trust in financial systems, as demonstrated by the public's outrage over forex scandals. Banks manipulate currencies primarily for stability, profit, or strategic reasons, mostly within legal frameworks, but occasionally crossing into illegality. This distant influence shapes emerging economies and raises fairness issues. In the next part, we'll investigate scandals that unveiled these hidden strings, ranging from global cartels to rigging of South Africa's rand. Stay curious.